Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure to speak with Danielle Lacalle, Chief Economist at Tressis. And before we get started, don't forget, tickets for the upcoming in-person crypto gathering in Miami are now up for sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Daniel, welcome back to the show. Always a pleasure when you join us. Perhaps none so more than today. Look, this is an interesting time. I'm really excited to talk about everything that's happening from a big picture macro perspective. Daniel, tell us everything about the way you see what's happening right now in this weird period between Tuesday, November 5th, 2024, and Monday, January 20, 2025.
Thank you so much, Ash. Real pleasure to be here. I think that what we can say about the world economy right now is that it's slightly worse than what we expected in the beginning of 2024, and that we need to pay a lot of attention in 2025 because a lot of what has been relatively decent about the economy in this year has been coming from a very aggressive level of government spending. 2024 was a year of elections all over the world. More than 70 nations were in the process of elections. And as anyone that is watching us or listening to us may imagine, 70 countries with elections means a lot of governments spending a lot of money very, very quickly to try to gain votes. And that means GDP bloated by government spending. Therefore, it is very likely that what we will see in 2025 is sort of a hangover of that process. Meanwhile, the manufacturing sector continues to be exceedingly weak. I think that it's pretty obvious in the way in which commodities, for example, are behaving despite geopolitical risk. So we need to be very prudent in general about expectations of very strong growth in 2025. I think that the logic would dictate that the process of persistent inflation with worse economic growth than expected, and certainly less productive growth than expected, is something that we can look forward to. And there's a very distinctive difference between economies. No, on the one hand, we see Asia that is growing very, very strongly, and the United States, which is likely to see a supply side driven recovery of the private sector, whilst the Euro area and Latin America seem to be lagging yet again after years of being behind the world economic growth average.
Daniel, let's talk about all of that right now. So many good points you raised there. Obviously, our viewers are familiar with what's been happening in U.S. equity markets, still absolutely on a tear, about 31% on a trailing 12-month basis on S&P 500. Talk a little bit about the underlying economic growth that drives those earnings, that drives those valuations. Talk a little bit about where you see growth at this moment, and then we're going to layer in the spending component and how that may impair this May going forward.
One of the reasons why the U.S. stock market is so strong is because there's been such an enormous level of what economists call liquidity injections, which ultimately is government spending. No? So government spending and a Federal Reserve that has been headline hawkish, however, in reality, very, very dovish, has driven multiple expansion in the US stock market. But we're starting to see some positive trends. The Russell 2000 is starting to catch up. And I think that that is a positive because it's basically showing that expectations of earnings in the US economy are actually going faster than what has been driving markets, which has been fundamentally the impact of very large stocks, multinationals with global businesses, which have led the entire stock exchange. Therefore, what I think is 2024 is likely to be an anomaly in the next 4 years, because in 2024, if you look at the level of growth, we're basically talking about a 2 trillion deficit with an increase in GDP of about 1.8 or 2 trillion. Therefore, very little real growth, excluding the accumulation of debt. And at the same time, weak manufacturing and consumer spending driven by a new record high in credit card debt. So what we can expect for the next year is probably a cooling off of that environment, reduction in government spending, probably a recovery in the productive sector, but it's very likely that we will see some significant earnings downgrades in those very aggressive multiple expansion names that have driven the S&P 500 and the Nasdaq, the tech companies, the not the Magnificent Seven, because they're not seven anymore, but the Magnificent Four. No.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
So Daniel, you mentioned this idea of the Russell 2K catching up with the S&P 500, 27 or thereabout percent on a trailing 12-month basis on the Russell 2000 right now on my screen, slightly trailing what I said earlier, around 31% on S&P 500. But let's talk about that here. This idea of GDP growth, underlying growth in the U.S. has been relatively strong. I believe Q2 2024, 3%, Q3 2024, 2.8%, relatively strong in terms of trend growth. Talk a little bit about GDP in the U.S. And abroad, more generally in the developed world.
Well, it definitely worries me when we get such a level of GDP growth coming from very elevated government spending, huge government deficit, and rising debt. No, that is never a positive. However, if we strip out the growth coming from more debt and more government spending, the productive sector hasn't done that badly. And what we can see is, for example, is that a real GDI, gross domestic income, is trailing behind GDP, but is also showing a decent level of growth, which is positive. And I think that what we're starting to see is that there is an opportunity for the businesses, smaller businesses, and the companies that are driving their business more within the US economy to start thriving in 2025. As for the rest of the developed economies, there's not much positive to say, because Germany is in deep recession, and it's an absolutely dreadful state. It's been the industrial sector has been obliterated. The energy component of the industry is exceedingly high, and therefore competitiveness is weaker. The automotive sector has been decimated. So Germany is in a very, very challenging situation. France as well. And the stock market is not helping either, because the stock market is also underperforming. The UK is in a recession that is not likely to get any better with the latest budget presented by the government, which has been very, very negative for business. So you have basically some Asian economies that are doing well, but not much to find in terms of economic growth in the developed world, apart from the United States, which is in a completely different universe compared to the Euro area, the UK, Japan certainly, and the biggest names of the European Union.
Daniel, I'm so glad you mentioned Europe here. We don't get to talk about it enough. Let's talk a little bit more about your forward outlook. You mentioned some of the fairly grim prognosis for what's happening right now. You mentioned UK, France, and Germany. Talk a little bit about what your forward outlook is in terms of real economic output.
Yeah, for France, I think that the level of growth for 2025 is not going to exceed 1.5, 1.2% at best. And that is if they get together their public finances and they sort out all of the political problems. And in France, political turmoil impacts economic growth very, very severely because the economy is hugely dependent on a stable government. No, it's not like the UK or the United States that has a more, let's say, less dependent private economic sector. So France very weak. Germany may escape recession with a growth of 0.5, 0.7% in 2025, but it's going to come mostly from government spendings and the base effect of the inflation of 2024. And in terms of the UK, we believe it's going to be entering into a recession in the second half. It'll catch up a little bit in the first half of the year, but the latest budget and the economic uncertainty that is surrounding the private sector with higher taxes and more government spending is likely to hurt the economy quite a bit into the second half. Therefore, we're moving in the developed economies, Europe and the UK, with very low levels of growth and decelerating growth in the countries that have done relatively better, like Portugal, Spain, or Italy, because those have been driven by a record level of tourism. And tourism is always obviously a positive effect, but does not last forever in terms of year-on-year growth. So maybe an escape from recession, but nothing spectacular. We're talking about, in general, stagnation with persistent inflation.
I want to talk about something that you just mentioned that you know a great deal about, particularly in France, this idea of the broader politico-economic context for this economic development that we're talking about here. Tell us a little bit about what's happening on the ground in France, particularly for our American viewers who don't follow this as closely. I think many probably know about the Yellow Vest movement in France, some calling it the most intense protests since May of 1968. Talk a little bit about where that stands and how it relates to the weak or anemic economic growth that you just described.
Well, if you think about what we hear all the time in the economic debate, we tend to hear that strong government and high taxes are the solution for many economies. And the proof of that not happening is France. France has the largest government in the OECD in terms of relative to the economy. It has very high taxes and a very aggressive social network. And what that has created is 3 decades of stagnation, a completely unsustainable deficit, very elevated debt, and more importantly, social discontent, which you just mentioned. It is impressive to see how an economy that allegedly, according to Keynesian principles, should be doing phenomenally due to the enormous level of welfare state and entitlements paid by the government, how social discontent is enormous. Taxpayers are completely asphyxiated and definitely angry, but at the same time, the citizens that receive those entitlements and those subsidies are also angry and discontented because they have gradually become a dependent subclass with very little opportunities. So France has gone from being the promise of the new Keynesian approach to the reality of a fiscal nightmare. And the problem is that politically, it's very difficult to solve, because in the political landscape in France, you have basically one big party that wants to maintain government spending and maintain the high levels of taxation. You have one big party that wants more spending and lower taxes, therefore higher deficits and higher debt. And then you have a third large coalition of left-wing parties that want even higher government spending. Therefore, it's basically a choice between higher debt, or absolutely insane debt. And that is a big, big problem for the euro area, because France is probably, with Germany, the jail that puts it all together.
So we're going to talk more about the debt and deficits issue in just a second, but I'm curious to hear you unpack a little bit more about the discontent on the ground. You mentioned this sense that there are a lot of French workers who are feeling asphyxiated by the level of taxation, and then you said something that was very interesting, which is this idea of a class of dependency being created by this that has also paradoxically perhaps driven discontent. Talk a little bit more about that, about how those cultural coalitions come together to manifest these challenges that you're describing.
Well, think about this. You basically have a system in which there is a very large government that is constantly penalizing high productivity via taxes and subsidizing low productivity via subsidies. At the same time, you have an increase in immigration that receives those subsidies but doesn't participate of economic growth when there is some, and certainly feels constantly almost relegated to ghettos, and definitely becoming a dependent subclass. So what happens is that everybody's angry. Taxpayers cannot pay anymore because it's just ridiculous. What's happening in France is that between indirect and direct taxes, an average salary is paying more than 60% of the wages earned in a year in taxes, between direct and indirect, which are enormous, the indirect taxes as well. So taxpayers are very angry. And at the same time, you have those recipients of those entitlements, immigrants, low-skilled workers, even public sector workers that are increasingly angry about the fact that obviously with an economy that doesn't grow, they may have some support, but they are not seeing any of the benefits of being in what is, in any case, a very wealthy country. So it's proving how anti-social many of these social policies are, and it's very, very concerning, because it's something that is happening all over Europe. The moment that you have seen that economic growth has started to stagnate in the euro area, and it's not something that has just happened, that has been going on for a while. Inevitably, what happens is that inflation is eating away the wages of the people that produce, and that taxes are destroying the ability of the middle class to thrive, while the poorest are not able to rise to the middle class. So the middle class is being eroded through taxes and inflation. The so-called high class is basically just leaving the country, or stopping investment and not taking any more actions because it's going to be taxed away, and the poorest are becoming poorer. Just to give you an idea broadly, if you look at the European Union and you put them together with US states, there are many countries in the European Union that are poorer than the poorest US state in terms of GDP per capita, poorer than Mississippi. And France is right there, close to what Mississippi is in terms of GDP per capita, which shows that elevated government spending, huge government size in the economy, high taxes and high entitlements don't deliver social improvement, but actually social discontent.
Daniel, that's so well articulated, and it's such a dangerous cocktail of these forces. This almost witch's brew that seems to be on tap. I'm curious, when you talk about that, what are your thoughts on the way young people are perceiving this? How are younger workers, say in their 20s, college age, recent graduates from college, and young workers more generally interpreting this? Where do they see the potential solution, at least in their view, of what's happening with these challenges?
What is very concerning is that it's basically divided in two groups, if I can be simplistic. One group of young students that are approaching their first job or within the first job are basically seeing this as a failure of free market and failure of capitalism, and are becoming anti-capitalist and anti-free market and pro socialist. And that's seen, for example, in the latest elections in France. And on the other hand, what is happening is that there is another side that is going to the other side of statism, which is very right-wing, pro-free market, private property, but very right-wing. So it's polarizing. It's very polarizing. I mean, it's pretty much what you're seeing in the United States, but even more concerning, because what we are not seeing is people understanding that the problem is being created by the state, no? Or at least not enough within the what we could consider a sizable electoral vote part, no?
Let me ask you this. As we talk about these challenges faced by France and other European nations, and in some places it's similar, in other places it's different, but talk a little bit about what the impact this plays on capital markets in Europe. Talk about the French stock market and also the euro. I've got a chart on my screen right now looking at euro USD trading at 105 right now. But give us a little bit of a sense of how you see some of those challenges translating into risk asset market prices.
Well, there's a tremendous negative impact, which is that the entire monetary policy and the entire fiscal policy is driven to continue to bloat government spending and to continue to disguise public sector fiscal imbalances. Therefore, what is happening is that the capital markets is basically one entire bet on the sovereign debt and the large companies that are very close to being almost similar to sovereign debt as well. No? So what happens is that there's an erosion in the investment side. Investment is plummeting in real terms, because if you look at investment relative to GDP, it's basically flat or slightly down in some nations. And when you look at that investment and you look at productive investment, but furthermore, innovation and technology investment, it's very, very limited. So one of the problems of the euro area is that if you look at capital allocation, if you look at it compared to the United States, about what the United States puts of capital into investments in private equity, in venture capital, in technology, in innovation, in the euro area, it's about a third. It's about a third in nominal terms. Okay, so that's incredibly dangerous, because productive investment is being sidelined, and at the same time there is a very large component of the capital markets that is basically there only to support very elevated government deficits and very elevated government debt. So the entire euro area is basically betting on one thing and one thing alone to drive capital markets and to drive investment and to drive growth, which is monetary policy. And everybody is all day almost discussing, oh my God, what is the ECB going to do? Shall we put nominal negative rates again, another QE, whatever? It doesn't work. And it doesn't work because it's not transferred to productive investment. Therefore, for investors, that means multiple compression. Even though the stock market may rise alongside the rest of stock markets, what you see is that the multiples at which European companies trade relative to the same sectors in the United States are compressing. And what you also see is that the smaller companies don't translate into larger companies. So it's very interesting to see, for example, in the German stock market, in the French stock market, how there's an enormous gap between the companies that are benefiting from that level of monetary expansion and the ones that are suffering from a very weak level of economic growth. So in general, what all of this is telling us is that it's almost impossible for the European market, for the stocks 600 or the individual nations' stock markets to outperform the United States, because technology is a very, very small proportion of the stock market. It's about 4%, if I'm not wrong. And at the same time, the stock market is mostly comprised of very stable, very large, very boring, but no growth or very little growth multi-mega cap conglomerates. So it's basically a challenge to find real opportunities. Although if you need to do that, you need to go deep into the indices and not look at the larger components of those indices.
Daniel, you mentioned this idea of all eyes are always on the ECB. Let me ask you this. You talk about the impairment of that transmission channel from the central bank to the real economy. Is one of the challenges there just the basic notion that you have economies operating at different speeds across the euro area, and it's very hard to find a one-size-fits-all solution for all of them at any one point on the curve?
Yeah, and the problem is that every time that anybody sees those problems, what everybody assumes is that the solution is more centralized planning, is more government spending, and is more fiscal stimulus. It's not that way. What we need to understand is that the problem is that you cannot find a one-size-fits-all solution for the European economy for a very simple reason, because there's no such thing as a one-size-fits-all. In the euro area, what you read constantly with the Draghi report, with the letter report, with Ms. Lagarde's comments, is that they feel that there is a frustration because the transmission channel of monetary policy is not working. But it's not working because every time that people see that there is a problem of too excessive regulation, very high taxes, and very low productivity, they decide to solve it with more taxes, more centralized planning, and therefore lower productivity growth. Many of the problems of the European Union are fully created by itself. The German problem certainly is. Yeah, the decision to destroy the automotive sector was a political one, and until they found out that they don't have the ability to compete in the electric vehicle market. The decision to destroy the nuclear fleet and make energy prices soar was completely political. So all these things, instead of addressing the problem, which is way too much central planning, way too much intervention, and not letting economies breathe, is always tried to solve it the opposite way. And when you look at the United States, everybody understands that, that Texas doesn't bail out California, and that, Michigan doesn't bail out Missouri, that you have completely different fiscal systems, and you have a bottom-up approach to the economy instead of what we have in the European Union, which is a top-to-bottom approach to the economy, which asphyxiates the small and medium enterprises.
Yeah, with the exception, of course, of disaster relief on the short term here in the U.S. But it is so interesting. You mentioned this view that it's like the status quo didn't work, central planning didn't work, the solution didn't work. Let's double down and try it more.
Exactly. If you think about it, everybody was super excited about the Draghi report, which made a fantastic, absolutely undeniable diagnosis of the problems of the European Union. Lack of competitiveness, excessive bureaucracy, excessive administration costs, huge taxes, and lack of innovation investment. All of that was absolutely correct. Until you get to the last pages, what is he recommending? More. More of the same. More of the same. More spending, but centralized in a more aggressive way. It's not going to work, and it doesn't work. And in the case of Letta, he is recommending to implement a digital identity card that is linked to the digital euro, and that will solve all the problems. No, they won't. People will run away from government surveillance, and that's a big issue.
Yeah, and that's what you see when you look at that long-term euro chart, where you just see that drift down to where we are now at about $1.05.
No, and this is another problem, is that the idea that you're going to gain competitiveness by having a weak currency is ridiculous. You know, the euro should be a project that should be defended, but it cannot be defended when the objective is to make it a subterfuge to maintain the enormous fiscal imbalances of governments, and the idea that the euro is going to strengthen with an ECB that cannot be hawkish has its supposed higher for longer policy lasted less than 14 months. It's a joke, no? Its supposed hawkish policy meant monetizing the entire next generation EU plan. Therefore, it's very I don't see how you can be bullish the euro apart from those little spikes that you see short term that look to me like short opportunities, no?
Yeah, you mentioned a little bit the imbalances. Talk about those imbalances, how they manifest themselves, Target 2 and other flow of funds between member states. Just to give, particularly our American viewers, a little bit of a sense of the challenges underneath the hood in those economies.
I'm going to be very simplistic, but people will understand this. The euro area is a vendor financing scheme in which Germany is financing the monster irresponsibility of many of the nations that joined the euro area by letting them import more of German goods and services. Okay. So what happens is that there is a giant increase in that imbalance, in the Target 2 imbalance, which is what shows the difference between what is owed between one country and the rest. No? The other element that is, in my opinion, very, very problematic is that the euro area has been created as a bull market construct in which as long as the economy is growing, it does not matter if the growth is coming fundamentally from government spending and from debt. However, when the economy starts to stagnate and inflation appears, which is something that the euro creators did not foresee, then the entire thing crumbles and it becomes closer to Japan. So ultimately, basically, what ends up happening is that for Germany, being in the euro area has some benefits coming from investment of and purchases of German goods and services from other euro area countries, but it also has the enormous burden of inflation and maintaining the solvency of other nations with their own credit viability.
Where's the escape valve for this, Daniel? Where do we start to see those stresses materialize? Is the euro, is it in bond prices in Europe?
I think that it's going to, there will be, we don't know when, but there will be a debt crisis in the euro area sooner rather than later, because it's impossible to disguise everything under the ECB umbrella, because it manifests in inflation. The European Central Bank seemed like the perfect solution to this bull market construct, because when it came time to do a quantitative easing program, there was very little inflation, everything looked good, and the ECB could disguise the fiscal insolvency or the fiscal challenges of the euro issuers. But now there's inflation, and there's persistent inflation. And inflation measured as CPI has been tweaked with, as we have seen in so many places, the calculation of CPI has been tweaked with to show a completely different reality than what citizens perceive. So now the ECB is caught between a rock and a hard place. The ECB, on the one hand, cannot really take hawkish measures, and at the same time, if it goes too dovish, then the problem is that the impoverishment of citizens is much larger, and without any economic growth, the discontent is significant. In the United States, that same policy led to discontent, but with growth and with real wage growth. And in the euro area, you don't have any economic growth and you don't have real wage growth.
Let me ask you this. I back in 2010, I wrote an article for CNBC. Here's the opening line. I want to read this. This is 2010, November of 2010. One day, reality sets in. The most powerful force in the universe isn't love. It's the bond markets. I wrote this obviously about the 2010s debt crisis in Europe. I guess my question is, when you see all of these structural forces, almost like a vice grips squeezing economies, how long can this be swept under the carpet for? How long can you pretend and extend before that moment happens?
It's very, very difficult to keep it for a long period of time. France now has the same risk premium as Greece. Obviously, the Greek risk premium has been brought down by the ECB action. But what's important is to show that, little by little, these things, risk builds very, very slowly and happens very fast. The ECB thinks that it has everything under control because it has the anti-fragmentation tool and because it has the ability to increase quantitative easing according to the requirements of the market. That's not the case. That is not the case because that is dealing with the flow of debt, not with the stock. The problem that you saw in 2010 that manifested in 2011 was a stock problem, is when investors started to sell their European bonds, the ones that they had already issued and were already in their books. It was not just a problem of flow, i.e. deficit financing every year. It was a problem of investors saying, I don't want to have the bonds that I had already collected in my portfolio of these nations. That happens, and it's likely to happen again. And if the policy of the Federal Reserve now is going to be more hawkish, we're going to have probably less rate cuts than what were initially expected. And at the same time, the United States government takes finally care of the deficit spending and starts to really cut deficit spending, then, like in 2010, which manifested in 2011, those enormous imbalances of the euro area issuers are going to transpire. Right now, people look at Spain and they say, hey, Spain is growing, Portugal is growing, Italy is growing. So the problem is not in the Southern European economies, the problem is in Germany because it doesn't grow. That is not true. Germany, it doesn't have a problem in the bond market and certainly doesn't have a problem of solvency. What is happening is that everybody's looking at GDP in the Southern European economies, but is not looking at debt accumulation in those economies. So like in 2003, when everybody said that Greece was the motor of growth of the euro area and Germany was the sick man of Europe, 4 years later, boom. People look at GDP as if it was the solution to everything without looking at GDP, debt accumulation, interest expense. Interest expense is becoming the largest item in the budget in most of the Southern European countries, which means that the moment that bond yields really start soaring, that is going to be a big problem. Obviously, we don't know when, but like you did in 2010, it happened 12, 14 months later.
Yeah. Let's talk a little bit about this. I mean, at one point, talking about GDP here. I mean, the Greek economy. I mean, people remember the Cypriot banking crisis. They remember what happened in Greece. Just to give a sense of the relative size of these economies, the Greek economy is a little south of 250 billion U.S. dollars. France, 12 times as large. I mean, $3 trillion. These are. I mean, it's very hard to ring fence that kind of debt if there were to be a problem.
That is the case. That is the problem. The problem is that when the euro area, the European Commission, the ECB start forgetting that what they need to do is to really rein the public finances of governments, because if not, they're going to enter into a problem. By ignoring what is happening in Southern European nations in 2014, and now ignoring what is happening in France, the problem is not a small economy that I remember, I think it was Jim O'Neill that said that China created a Greece every 3 months. It doesn't matter. It doesn't matter. The next problem is not going to be Greece, and it wasn't. The next problem is going to be France, and France is impossible to bail out.
All right. I want to shift gears here and talk a little bit about the United States and just bring in some of these themes that we've been talking about. We talk a great deal about liquidity here. You mentioned at the top of the show. It's an important topic on Real Vision, the great work that Mike Howell has done, the great work that you've done, and others. The focus of liquidity conversations generally is monetary policy rather than fiscal policy, because you can see it happening so quickly. Obviously, September 50 basis point cut by the Fed, November 25 basis point cut by the Fed. You see it immediately priced into markets. Fiscal policy, on the other hand, may have a slower impact on the economy, but it's something that we need to talk about because, as we've been discussing here in Europe, those pressures can build up almost like tectonic plates beneath the surface over time. Talk a little bit about your view of the U.S. fiscal position right now.
Well, the U.S. fiscal position is a nightmare. Because think about it, a $2 trillion deficit in a year of 3% economic growth, 4.4%, 4.2% unemployment, and a tremendous level of inflow of capital into the United States is insanity in every shape or form. So if the United
Daniel,
States...
explain that to folks, because this is such an important point, and I want people to get it who don't have the background in macroeconomics, that generally you see this deficit spending during periods of recession. We've seen the opposite here. Talk about the boom on debt to GDP ratios and the challenges that we're experiencing right now.
Okay, people need to understand the following. Deficit spending is printing money. There is no such thing as the Federal Reserve printing money because they're evil or stupid. The only thing that they print is because the government has already spent it and increased issuance of debt. So deficit spending is printing money. If you have fiscal policy that is expansionary in a period of recession, that expansion may help the economy get back on track in a Keynesian way. I've never believed it, but it doesn't matter. That's what governments do, because the government has fiscal space. However, if what the government decides willingly to do is in a huge recovery, remember that it was in January 2021 when the Biden administration arrived, in a huge recovery with the economy already booming, you decide to massively increase government spending and massively increase deficit spending, what ends up happening is that you are destroying the fiscal space of the government for a period of contraction. It cannot take a decisive action, or certainly it cannot support, because the level of government spending is so bloated that in 2024, government spending in the United States is $2 trillion higher than it was in the 2019 pre-COVID period. So why is that a problem? Because that deficit spending and that increase in debt means in the future more taxes, less real wages, less growth, and certainly more inflation as well if it continues that way. So the path of insanity of the fiscal policy of the United States was predicated on the idea that nothing had happened so far, therefore continue. And that is hugely negative, because think about this. Imagine that you're driving, 150 miles an hour down the highway, and you think the following thing. I have not killed myself yet. Let's accelerate. The idea that nothing has happened yet and therefore you can continue to drive deficit spending higher for longer is insane. In the Treasury's own estimates, without estimating any recession, any downturn in employment, and any reduction in growth, the estimates of deficit 2024 to 2034 were $14 trillion more of debt. That is crazy. And that, again, I come back to the point, for citizens means less economic growth, less real wages, lower productivity, and more inflation and more taxes. So you have to be exceedingly worried about that. Therefore, the United States was moving very, very fast into a debt crisis. And again, like we were saying before, we don't know when, but we know that it was on the path to it. And so what it needs to do now is to curb that deficit very, very quickly. And it needs to do it in two ways. Can only be only one. It needs to reduce government spending. That is not enough. And it needs to accelerate economic productive growth. It needs both. So that may take care of the deficit problem. Just bringing the deficit to 2% of GDP would certainly be enough, more than enough, for the dollar to remain the world reserve currency, for inflation to come down, for the entire economy to go back in demand. And it would still be a deficit, but it would be at least acceptable in terms of the level of economic growth if it is boosted from the productive side.
Yeah, on a deficit to GDP basis. Talk a little bit about what your outlook is for the fiscal situation in the US based on some of what we've been hearing from the incoming administration in terms of policy plans. Obviously, Mr. Musk and Mr. Ramaswamy getting a lot of buzz here in the United States. But in terms of the translation into actual policy and to actual macro mechanics, talk a little bit about what you see going forward.
I think that the importance of this Department of Government Efficiency is to make public to the average citizen all of the different areas in which the government is overspending. Because a lot of people say, yeah, the government has to reduce spending, but I don't know where. And when I look at and when I Google government spending, it basically, all of it goes to interest expenses, defense, Medicare, Medicaid, Social Security. So where are you going to cut? Well, the reason why it's important is because they are going to come to the average citizen and say, look, here we're spending millions that are completely unacceptable. Here we're spending millions. And the way to really cut has been proven in Argentina by Milei and maybe proven by the Department of Government Efficiency in the United States, which is to cut a lot of those things that so that headline macro analysts basically just don't care, because you basically look at $1 trillion figures. No, so you start cutting million, 10 million, 11 million, 100 million pieces of unnecessary spending. You're going to immediately reduce the deficit very, very quickly. My own estimates are the following. I think that with the policies that have been announced, government deficit can go down from the current insane level of 2 trillion to 1 trillion in 2 years. And if at the same time economic growth is accelerated, the deficit to GDP can be brought down very quickly. Finally, we also have to take into account if there's going to be the amount of tariffs that have been announced. If the tariffs to China are announced, that is another $320 billion of revenues for the United States. So basically what you have is cut spending, increase growth, and the effect of tariffs if they are implemented. But tariffs are not the main driver. The main driver is budget cuts. And it can reduce the budget by not just making direct cuts on previously spent, but improvements in efficiency. For example, it is ludicrous what the United States spends in healthcare when at the same time you have the possibility of improving the expenditure very, very rapidly through competition and with more level of free market options for healthcare providers. So all of that may be the solution. Obviously, we'll see how they implement it, but I'm sure that Ramaswamy and Musk are not going to basically just present a paper and let it die in the depths of the deep state. I'm sure that they will present to people the reasons why you can actually cut between $1 trillion to $1.5 trillion in the legislation without harming economic growth or social services.
So that would be essentially a 50% reduction in the deficit to GDP ratio as a consequence of cost cutting and presumably increased growth from some of these pro-business policies. How long does that take to have a significant impact on we're talking about on the flow side now, on this debt stock side? How long does that take?
Oh, the key thing here, and my recommendation, is to do what we have seen in Argentina and we have seen in so many other countries, which is to do it decisively and quickly. If you do it gradually, it's not going to work. If you do it gradually, it's not going to work. So, and I think that maybe in this second administration, the Trump may have learned that lesson, that, you know, when you're told, oh, well, let's take it little by little, then it doesn't work. You need to be aggressive, and it needs to happen within the first 100 days of the administration, because if it doesn't happen in the first 100 days of the administration, by June you have a debt ceiling problem.
Yeah. Boy, if we could get some competition and improved outcomes in healthcare, that would be a huge tailwind for the United States. Obviously, healthcare in the news here in the US and especially in New York for all the wrong reasons right now.
Yeah, absolutely. I mean, and there are many solutions that have been published in numerous occasions. There's a great book. It's called America's Health Nightmare Solved. But most of it comes from lack of competition. In many states, you have one, maybe two healthcare providers, and that's basically cartelization of healthcare. That doesn't. So Americans suffer the negatives of a single payer system, but without the benefits of higher competition. All those things can be improved, and I think that there's definitely a large room to do that. And again, no one can say, oh, it's impossible to reduce the deficit. It's ridiculous. Of course you can reduce the deficit. You can cut it to zero. Put immediately in the administration the starting point, not at what you spend, but at what the deficit is. And you say it's zero deficit, and from there you have some room. But you need to start with the zero deficit, not from this is what we spent in fiscal year 2024, and therefore it goes up and up and up.
Daniel, let's talk a little bit as we talk about all of these issues and their impact on risk asset markets. Let's talk a little bit about gold and take a look, if we could, at the 10-year chart for gold. Obviously, well, the chart speaks for itself. It's essentially a $1,000 increase in this chart that we're looking at right now. Daniel, talk a little bit about your view of gold, what's driving this rally, and specifically talk a little bit about your forward outlook for gold.
My forward outlook for gold is that we are likely to continue to see gold strengthening for two main reasons. Number one is the increased demand from central banks. Central banks all over the world are starting to reduce their overexposure to euro area and US sovereign debt, and to balance it with more exposure to gold. They have such little gold, it's sometimes in the case of most of them, it doesn't get to 4% of the assets of the central bank, that there's a tremendous level of room to continue growing. And that doesn't mean that they're going to completely get rid of sovereign debt in their asset base. It's just to balance it with an asset, gold, that actually does protect you in a period of persistent inflation. So that's one thing, demand from central banks, which coincides with challenges of supply, because the underinvestment in gold mining is actually a significant problem, considering the demand for gold prior to central banks changing their policy. So that is, let's say, a second derivative of the of the first element, which is central bank demand. Central bank demand and shortage of investment that may create some scarcity. The second element that I think is very important is that we may be discussing the possibility of the United States reducing its deficit and reducing its tremendous fiscal problem. That's not going to happen anywhere else. Everywhere else, the policy is print and monetize, print and continue to disguise government imbalances. And therefore, gold as the counterpart of the enormous risk created by money printing is going to, in my view, continue to strengthen throughout the next year and the following, because people are starting to see that in another, we used to hear the idea that you needed to have a balanced equity and bond portfolio. Well, guess what? Governments are not going to give you real returns in this fiscal nightmare scenario. So bonds are not going to save you, sovereign bonds in particular, in an environment in which there may be some volatility and some corrections. And that's where gold plays a huge part in terms of having a balanced portfolio that allows you to generate returns over time.
Yeah, as I look at the chart more closely, more like a $1,500 increase in this $2,600 or thereabouts asset over a trailing 10-year basis. Daniel, as we're going down this line of thought, let's talk a little bit more broadly about commodities. You talk about some of the challenges in the traditional mix of U.S. equities and bonds held by many investors, retail and otherwise, here in the United States. Talk a little bit about the role of commodities in that portfolio.
I think that you need to look at commodities from a trading perspective, not from an long-term investment perspective. When you see a trend, like we saw with copper and electric vehicles, pick it up, make some money, and get out. Because the overall long-term trend of the Bloomberg Commodity Index and so on is actually very, very, very poor relative to equities and relative to other risky assets that may do well. But there are opportunities, and obviously, I think that the most important one is to not look at what we like to look, but what is important. What does that mean? We like to look at geopolitical risk, at conspiracy theories about supply and demand. Forget about all of that. That doesn't work. At least, at best, it works very short term. But what you need is to look at the real trends of money growth and the manufacturing sector impact. Money growth is going mostly, as I said before, to government spending and to credit card debt. Manufacturing continues to be weak. Therefore, the demand side of commodities is let's say, the element to look at, because supply is going to adjust to the demand side. So I'm particularly cautious on oil medium term. I'm more bullish, obviously, because of the seasonality with natural gas, but and with aluminum and copper, you have to take the trends from basically January to June. That may give you a good trend of growth in those prices, coming from electric vehicles, coming from renewables, coming from the discrepancy in the investment side that is going more to clean tech and less to fossil fuels, and that generates some potential. But in general, the commodity complex to me is not the most interesting investment on a long-term basis.
Daniel, a big show today with lots of big ideas, from the big picture macroeconomic outlook and narrative down to the price action in different currencies and commodities. Daniel, since we've had this very deep conversation here, how would you sum it up? Final thoughts, key takeaways for our viewers and our listeners.
I would say that the final thought is very unlikely that we will see any significant mean reversion in the market. I think that winners will continue to win and losers are likely to continue down the path of stagnation. I think that you cannot expect strong economic growth and high productivity growth with the fiscal and the taxation systems that are being globally built. That we need to address the imbalances that are being created in the public sector by protecting ourselves, investing in the assets that are actually shielding you from monetary destruction. And ultimately, what I would say to everyone is, you can almost forget about all of the other elements of valuations, etc., and think long term about what is inevitable, is that governments that have created these enormous levels of debt, and what's most important, all of the debt that will be issued in the future, i.e. those unfunded, already assumed commitments, all of that means monetary destruction. Therefore, be on the other side. Continue to invest in equities, particularly in the United States, particularly in disruptive and high added value sectors. Continue to invest in independent currencies and independent money that allows you to benefit from an environment that is not going to be solved through government deficits and government spending. And because of that, don't expect governments to give you real positive returns in their bonds or the bonds that they issue.
Well, with that, Daniel, I almost have to ask, what about Bitcoin?
I think the Bitcoin is phenomenal. I think the Bitcoin is showing, number one, that it is going from being a startup currency to something that is actually a contender, and that it is creating its own liquidity. And I think that is what's most important. So it's starting to decorrelate from other risky assets. I think that Bitcoin as well moves, as you see in these charts, in these periods in which it consolidates at a certain resistance level to continue going up afterwards. So what we need to pay attention to regarding Bitcoin is how it is separating itself from other cryptocurrencies, how it is becoming more a reserve of value unit of measure and method of generalized mean of payment, and at the same time, how it is creating its own liquidity and therefore separating itself from being an asset that goes up when everything goes up and goes down when everything goes down. I think that is what's most interesting about it. It's a very young, asset, and therefore the people that are talking about the future have a lot of things to look at before being certain about what the future is going to be. But what is important about it is that it has gone from being a startup currency with very elevated volatility to a much lower volatility and much more intrinsic liquidity generating asset.
Well, it's a teenager now.
It is a teenager, exactly. That's what we said the other day. I was in Mexico and they asked me, what is the future of Bitcoin? I said, what do you mean the future? It's in its infancy. Imagine what people would have said about the US dollar or about the British pound when it was 15 years old, that it was nothing, that it was irrelevant. So let's look at it. Let's look at it because it's growing and it's growing stronger. And it's actually, and a lot of the things that me and so many other people were cautious about, the thing that I always was most cautious about Bitcoin was the fact that its liquidity came from the US dollar. So the Fed hiked rates and the Bitcoin declined. But I think that the key point here is that it is building its own liquidity, is separating itself from other crypto assets, and it's generating its own narrative and its own story, and it's fascinating to watch.
Daniel, a great show. I hope you'll come in and check in with us again, Q1 2025, so we can talk about how this is all going.
It will be a pleasure. Absolutely. Thank you.
Well, truly a pleasure to have you here, Daniel. By the way, before we go, tickets for our upcoming in-person crypto gathering in Miami now up for sale. Head over to realvision.com/CG 2025. That's realvision.com/2025 to get yours. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.